Who really controls your money? That's the question posed today by Nikolai Hubble, Nigel Farage's writing partner in the Fortune and Freedom investment newsletter. And once again, they're asking a good question, but sadly reaching the wrong answer. And the answer in this case is keeping your cash under the mattress. In this video, why that is a very, very bad idea. Hello, I'm Martin Bamford from Informed Choice. I'm a chartered financial planner, and in this video I'm going to be talking about the madness of keeping cash under your mattress, which is the latest recommendation to be found in Nigel Farage's Fortune and Freedom newsletter. Now, I want to start by saying a big thank you to everyone who has watched and commented on my first Fortune and Freedom reaction video, which I published on YouTube just a few days ago. I'll keep making these, and I'll keep trying to explain why some of the nutty ideas coming across in this newsletter are such a bad idea for investors. So keep on liking and subscribing to this channel for more videos just like this. Now, in today's Fortune and Freedom newsletter, Nick Hubble, who's one of the co-authors, writes about counterparty risk, and that's his big focus for the newsletter. Put simply, counterparty risk is the risk that one of the parties to a financial transaction will go bust and renege on their financial obligations, their contractual obligations. And counterparty risk is absolutely a risk that we must consider as investors. And what we have to do as investors is think about the risk, try and quantify it, and then either avoid it completely, or if it's impossible to avoid, try and mitigate that risk. So as financial planners, we do not particularly like counterparty risk. It's very hard to quantify. It's very hard to understand where that risk might arise or how big that risk is. Much easier to quantify the risks associated with investing money in equities or bonds or property or in cash. Counterparty risk is a little bit harder to pin down. So one option as an investor is to avoid counterparty risk altogether. Now, despite what is said in today's Fortune and Freedom newsletter, counterparty risk does not exist everywhere. It's not associated with every financial product and every financial account you hold. It is limited to very specific financial arrangements, the type, quite honestly, that most retail investors do not get involved with. However, if counterparty risk is impossible to avoid, then you need to take steps to firstly understand that risk, and then secondly to mitigate it. And one very good way to mitigate the risk is to insure against it. Now, in this newsletter today, Nikolai Hubble talks about cash and the counterparty risk associated with holding a cash deposit with a bank. And of course, cash deposits within banks are protected here in the UK by the Financial Services Compensation Scheme. And the FSCS is covering your cash deposits up to a limit of £85,000 per person per institution. So you have a very good base level of protection in place, which mitigates that counterparty risk, if it even is counterparty risk. I'm not convinced that's the correct term for what he's trying to describe in this particular newsletter. Another way to mitigate counterparty risk is to choose very financially strong counterparties. Now, this one's a little bit tricky because often we have to rely on the opinions of credit rating agencies to determine the financial strength of a counterparty, and those opinions have been proven in the past to be a little inaccurate. And more importantly, perhaps, those opinions can change over time. And what we've sadly seen is investors getting involved in fixed term products, maybe 3, 4, 5, 6 years worth of products, and they can't get out of the product within that fixed term. But the counterparty risk backing up that product changes over time, and the financial strength of the counterparty may actually decrease. So you do have to be very careful that over time your counterparty risk does not increase while you're trapped inside a product linked to a particular counterparty. Now, something that makes a bit of a nonsense of this scaremongering we saw in the newsletter today is the fact that with the majority of UK regulated financial services products, your cash, your investments, are not held within the bank account of that product provider. They're held in a segregated account. And that's very important because it means if the financial provider, the fund provider or the product provider were to go bust at some point in the future and get into financial difficulty, they cannot simply call upon your money and use that to pay their bills, to pay their debts. That money is held separately in a nominee account elsewhere. The company simply cannot get its hands on that. So I do view that as scaremongering. This view in the newsletter today that counterparty risk means that should a company go bust, that company could take hold of your money and use it to pay off their debts. That simply cannot happen. At least that cannot happen here in the UK, and we have a very well regulated financial services sector here in the UK. The Financial Conduct Authority, for all of its failures, does a brilliant job when it comes to this type of consumer protection. If you start going offshore and using unregulated collective investment schemes, other unregulated services or unregulated and offshore investments, then be aware that your money will not necessarily be held in segregated nominee accounts. And should the company then go bust, you could be in quite a bit of trouble. The money could be tapped into. And where we've seen scandals about unregulated and offshore investments in recent years, that's often been the case, that the money has been used for the wrong purposes. It hasn't been kept separate and kept segregated for the sole purpose of investment. It's actually been used by the company to pay their debts, to pay their operating costs, etc. So do watch out. If you move away from UK regulated investments, you are in real danger. So let's talk about cash under the mattress. And this was the real reason I wanted to record this video today. In this latest Fortune and Freedom newsletter, this is the conclusion that Nikolai Hubble reaches, that counterparty risk in some way can be overcome by keeping cash under the mattress. And that is a really, really bad idea. Now, as usual, and as we've come to expect from Nigel Farage, this newsletter is peddling fear. It's peddling concern that you won't be able to access your bank account money, your deposits, your cash savings with a bank or building society here in the UK. That sort of fear is completely unfounded. Even during these very difficult economic times, when the bank finances can be a little bit stretched, you really have no genuine worry about banks going bust. Now, Hubble mentions in the newsletter Northern Rock, and yes, Northern Rock failed at the start of the great financial crisis. However, it is so important to reiterate that not a single saver at Northern Rock lost any of their cash savings. There was a nationalised bank bailout, and that money was protected. Nobody lost a thing. There wasn't even recourse to the Financial Services Compensation Scheme, so savers with Northern Rock were not limited to £85,000. It was actually a slightly different compensation level back then, but they were not limited by FSCS compensation levels because there was a bailout. There was a nationalisation of Northern Rock. So it is scaremongering to refer to Northern Rock and suggest that in some way that could happen again, and as a result savers would lose their money. The other bit of scaremongering within the newsletter today was this weird suggestion that some EU regulation means the next time a UK bank fails, cash deposits will be used to fund the bailout, what they call a bail-in. And this is the EU Bank Recovery and Resolution Directive. It's been in force since the 1st of January 2016, so of course it's nothing new. And the purpose of this particular EU directive is to save the good liabilities of a failed bank at the expense of the bad liabilities. Now, one of the good liabilities of a bank is cash savings, your deposits, your savings account. So this directive absolutely does not say that they would use cash deposits to fund a bail-in. That's actually the opposite of what it's saying. Yet there is fear within this newsletter. There is a suggestion in today's newsletter that your money, your cash deposits, could be used to fund a bail-in. It's nonsense, it's absolute nonsense. So don't worry about EU directives. I don't know what the impact of the UK having left the EU is on that particular directive. I know many of them are being copied across by the Financial Conduct Authority and by the UK government, so it's very likely a similar structure is in place. And actually there is a similar directive in place, a similar law in place in the United States, so it's not just an EU thing. This is a global banking mandate and how it works. But it doesn't mean that somehow your cash savings are at a different level of risk and could be taken to pay for a bail-in. That's absolute nonsense. So today's newsletter is peddling fear, but what I do find absolutely terrifying is this idea of keeping cash under your mattress. And that is a really bad idea for a number of reasons. Firstly, for physical security reasons. If you keep substantial quantities of cash in your home, that money is at risk of theft. Somebody could break into your house and steal it. It's at risk of damage through fire or flood or a rodent infestation, anything that could physically damage the cash cash. And you would want to check very carefully on your home contents insurance to find out what the maximum coverage is for cash within your property. I checked mine just before I started recording this video, and we are limited to £500 of cover should somebody break in and steal cash from within our home. So home insurance, home contents insurance policies tend to have these limits on them for different assets and different things that could be stolen or damaged by fire or flood. So do look out, if you're deciding to keep cash under your mattress, how much coverage you really have. And if you don't have much coverage, you could either up your insurance, that's going to cost you some money with a higher premium, or you could invest in a very robust and hopefully fireproof safe. So do think about that very carefully. Please don't tuck substantial amounts of cash actually physically under your mattress. The other reason why it is a terrible idea to keep cash under your mattress is inflation risk. Now, when you hold money in cash, its buying power is eroded over time by rising prices. When you hold money in a cash savings account in a bank or building society, the bank or building society reward you for holding that cash by paying interest and adding interest to your account. Now, interest rates, as we all know, are very, very low at the moment. Inflation is thankfully very low at the moment as well, but over the medium to longer term, inflation typically outpaces interest rates and therefore erodes the buying power of cash. So we don't suggest people hold cash as a long-term asset. It's typically a bad idea to do so. But it's even a worse idea to hold cash under your mattress because, of course, the bank is not going to pay you any interest on that cash savings because it's not with the bank, it's under your mattress. So no interest being paid means that inflation erosion is even greater and the buying power of the cash under your mattress is even lower over time. Now, there is absolutely nothing wrong with holding some emergency cash in your home so you've got ready access to money should you be able to get it elsewhere. From time to time, of course, banks do have computer failures, they have IT problems, the cash machines don't always work, and it's always useful to have a bit of cash around anyway to save you making that trip to the local ATM. So holding a bit of cash for real emergencies, not a problem. Holding a significant amount of cash in your house, under your mattress, in your safe, wherever it might be, that is where it becomes a really bad idea for reasons of physical security and inflation erosion. And if we start getting into, I guess, disaster scenarios and the real sort of fear-mongering that's associated with this newsletter, and we start thinking about end-of-the-world type scenarios, then you might think, well, it's a great idea to have some cash in the house. But actually, if you're thinking down those routes, I think start referring to what my friend Carl Richards, who is the Behaviour Gap and the Sketch guy, Carl Richards talks about a guns and butter portfolio. So actually, rather than keeping cash under the mattress, you're probably better stockpiling ammunition, tinned food, etc. for a real disaster scenario. Cash is probably not going to be much use to you if things get really, really bad, really bad. Hubble then moves on to talk about in today's newsletter investment assets and counterparty risk. Now, I hope I've already reassured you that as a result of Financial Services Compensation Scheme FSCS protection and also segregated nominee accounts, this isn't really a risk. So those apply equally to investments as they do to cash savings. For investments, the FSCS protection levels are different to the cash protection levels, so do check them out on their website. But you do get protection from the FSCS and you do get to see your money held in a segregated account for UK authorised investment funds anyway. So there really isn't a risk. I am really looking forward to future editions of this newsletter to see what sort of investments they suggest to overcome this counterparty risk issue, and I'll make future reaction videos as well once those are known about. I have a horrible feeling they are going to be esoteric, very high risk, and certainly not mainstream investments, because as I've already explained, mainstream investments simply don't have this issue with counterparty risk. And then Hubble talks about diversification, and yes, diversification makes sense. We all know that old saying about not keeping all of your eggs in one basket. From an investment perspective, diversification means diversifying your holdings across mainstream investment asset classes, equities, bonds, which are a form of corporate or government debt, commercial property, and cash. However, some people like to try and diversify using non-mainstream investment assets, so things like gold or Bitcoin or weird things, esoteric investments you really shouldn't get involved with. The risk associated with those alternative investments usually outweighs any diversification benefits. So if you're thinking about diversification as a way to reduce risk, be careful not to sort of leap out of the frying pan and into the fire chasing diversification, because the very added benefit of diversification as a risk mitigation tool can be lost through the additional capital risk you're taking with your money. I'd love to know if you keep cash under your mattress, and also, are you worried about counterparty risk with your portfolio? Do leave a comment below, and also that's where you can ask any questions, which we'll be very happy to answer. Please do like this video and also subscribe to our channel. I'll be making more of these Fortune and Freedom newsletter reaction videos as the newsletters are published and there's things to talk about, and hopefully to help educate investors on some of the issues that arise from the scaremongering we see in this newsletter. Thank you for watching. Until next time, goodbye.